Swayam Prabha. Digital India. Educated India.
Hello everyone, welcome back to our continuing series on business cycles, part of the course on economic environment and business strategy. In this section, we turn to one of the most significant macroeconomic events in modern history, the Great Depression 1929. Although nearly a century has passed, its relevance continues to shape how we understand economic crisis, policy responses, and the evolving relationship between the state and markets. The Great Depression was more than just a financial collapse. It was a global economic breakdown that profoundly reshaped economic thinking and public policy. For businesses, it brought a period of extreme uncertainty, mass unemployment, deflation, and demand collapse, forcing a fundamental rethinking of strategy, investment decisions, and the role of government in economic management. So, in this session, we will begin by examining the magnitude of the depression, highlighting the sharp contraction in output, employment, and prices. And next, we will trace a series of events that led to the crisis, from speculative asset bubbles and banking failures to monetary tightening in the United States. Finally, we will explore the policy responses and the major intellectual debates that followed, from early laissez-faire inaction to Roosevelt's New Deal, and from Keynesian calls for demand-side intervention by the government to monetarist critique of central banking errors during the crisis. By the end of this session, I hope you will gain a deeper understanding of the causes and consequences of one of the history's most severe economic downturns and why it continues to serve as a foundational reference point for thinking about macroeconomic policy and business resilience strategy. So, to begin, let me take you through an overview of major modern recessions, starting with the Great Depression of 1929. So, you can see here that I have listed here the major recessions, starting with the 1929, that is the Great Depression. And you can see the duration, it lasted for nearly 10 years, and the peak unemployment has reached 25% and the GDP has declined by 30%. And then in 1973-75 another major recession followed, and then in 1980, 1981, 82, then in 1990, 91, then another one in 2001, and then recently the 2008-9 financial crisis, that is another major financial crisis happened in the economic history, that was in 2008-9. So, what I will do here is that first let us begin with the 1929 depression, and I will spend most of the time on explaining, understanding the 1929 depression, because this is one of the major depression in the human history. Then to understand what led to the depression of the 1929 and what were the policy response, this all will help you to understand other recessions and depressions as well. To begin with, to give you the magnitude of the problem, that you can see the main issue at that time was that the 1929 depression is called Great Depression of 1929, and mainly the depression means, or the business cycle means, a kind of a disequilibrium in GDP, that is in this case the aggregate demand was less than aggregate supply. So, in this picture it reflects everything during the 1929, starting from the poverty here and the unemployment here. You can see the free coffee and donuts for the unemployed. So, everything is reflected in this picture. So, the 1929 Great Depression, it was called the mother of all financial crises in human history. So, it lasted for almost 10 years from late 29 to 1939 and affecting nearly every country in the world. So, marked by steep declines in industrial production and prices, that there was deflation and there was mass unemployment and there was banking panics and sharp increases in the rates of poverty and homelessness. And it is also characterized by a stock market crash and bank panics and as well as monetary contraction in the economy. Let me take you to the brief facts, some of the important facts about the Great Depression. So, you can first, there was stock market crash. The stock market fell by 85% during in the initial phases of the depression, and the GNP fell by 30%. That the GNP means the sum of economic activity. So, that fell by that contraction of economic activity, the GNP, that was 30%. And the unemployment rate, it rose from 3% to 25%, and the net investment was negative, and the consumer price index, that is the inflation fell nearly 25%. That means a deflationary pressure in the economy. So, you can see that a decline in output, unemployment, and at the same time and as well as the inflationary pressure in the economy is almost became deflationary in nature, and that means is characterized with the true features of a economic downturn. That means low output and employment characterized accompanied by low inflation. So, here this table, the economic statistics of Great Depression. So, I have this table shows the movement, the changes in the key economic variables over time from 1929 to 1939. So, this is the period through which the till the Great Depression long lasted. So, you can see the GNP in billion and investment in percentage of the GNP, the proportion. You can see that initially it is 17.8 and 13.5%, but over time you can see that this has declined. The investment, that is the key component of aggregate demand, but it declined during this period. And the government expenditure also, you can see that there is no big change, but slight increase is there, but at the same time GDP has declined. Then the unemployment rate, you can see initially it was only 3.2 and 8.7, but then you can see that it has increased. There was a dramatic increase in the unemployment rate. And about the consumer price index, using 1929 as the base year, you can see that consumer price, this means this is a negative inflation. You can see that is below 100, that means nothing but negative inflation. We can call it as deflation. And the interest rate for key financial instrument, that is for the commercial paper rate, that declined, and the AA, the highly rated debt instrument, also there is slight variation, there is not much decline. But then stock market index, you can see this almost crashed, and there is the money supply, it declined, and the full employment surplus as a percentage of GNP, that also you can see there is a decline. So, these are the key facts. So, based on this we can see that you get a sense of the magnitude of the Great Depression of 1929. And then I am showing you a figure that shows the real GDP and the potential GDP. So, this is the real GDP line. You can see that this is the real GDP over time, the observed GDP. So, you can see from 1929 to 1931 till 1941, you can see that there is decline in GDP over time and slight increase over time. So, you can see this is the pattern of GDP growth. So when we draw a potential, the GDP trend line, the output trend line, that is the potential output or potential GDP or the natural GDP, that is this trend line. So this is if there was no depression or no uncertainty in the economy, if it was on a natural path or the natural level, the output would have grown in this way. That means you can see this is the natural output. So, but the actual output growth was only this much. You can see the below, this is the actual output or the observed output. So, this gap, this is called the recessionary gap, that is the negative output gap. So, this is the negative output gap that you can see. So, this shows the magnitude of depression on the output. And moving further about the another component, you know that when the level of economic activity comes down, that means when the GDP growth declines, and that we already seen in the previous slide, there is a large recessionary gap. Then the unemployment rate, obviously when the output level of economic activity declines and the output declines, obviously the inputs demand also decline. Then you know that labor is one of the key input, and then what you can see here is that the unemployment rate in the US is rose from 3.2% in 1929 to 25.2% in 1933. So, this shows everything, that means the magnitude of the unemployment problem in the US. And in the Great Britain, the unemployment rate was above 10% over the decade from 1923 to 1935. So, in other industrial countries, nations, most of the other industrialized nations like Germany, Canada and all witnessed the same kind of similar kind of unemployment problem in the 1930s. I am also showing the data on some of the key economic variables that are related to economic performance, and one is real interest rate. What you need to do that first, the nominal interest rate has declined. Why? Because nominal interest rate is the real interest rate plus the inflation. So, you can see first you look at the rate of inflation. During Great Depression period, you can see that there was negative inflation, that is deflationary pressure. So, that means the inflation declined there because there is no demand, there is shortage, deficiency of aggregate demand. Because of that, there is a negative rate of inflation, that is deflation. So, as a result, what you can see that investment purchases are affected by the rate of interest minus the rate of inflation, that is the real rate of interest. That means when suppose you can see the nominal rate of interest remain almost same, but because of the inflation, there is a negative inflation. As a result, you can see that the real rate of interest has increased. The real rate of interest, you can see this has increased. That is nothing but the cost of borrowing for the firms had increased. So, that means the cost of input, the cost of capital, that has increased during the crisis. Then another major event in 1929 was that the stock market crash of 1929. The New York Stock Exchange was booming for the last 4 years before 1929. So, there was an expansionary phase before 1929. So, what happened at that time was that most people were investing in the stock market, and as a result the value of the stock exchange tripled from 27 billion to 87 billion in 4 years. You know, at that time because people found that investing in stock market is one of the best investment opportunity. Even people borrowed money from the bank and from other lenders, and then they invested this money in the stock market with the expectation is that they can make huge return. So, even many people what they did that even whatever the income they saved their money, they generated some loanable funds, some capital, and that amount they pumped into the stock market with the expectation is that they can earn huge return. That was obvious because the first 4 years before the 1929 period, you can see it was an expansionary phase and the US stock market underwent a historic expansion. However, these were all bubbles because this was not based on the true economic foundation of the economy as well as the firms, and there was market crash. But you can see that this is the stock market expansion period was this, but by 29 you can see from here, when you move here, you can see that there was a decline in the stock market, and it became the period of the stock market in December 1932 with at 10% of September 1929 peak value. So you can see that it is a steep decline in the stock market index, and in other words, this is nothing but the stock market crash. So once prices began their inevitable decline in October 1929, stock prices fell by 33% between September and November. The result was a profound psychological shock, because people have all been thinking that they can make huge profit by investing in stock market, and because of this a loss of confidence in the economy among both consumers and businesses. And this was called in October 24. This day was also termed as Black Thursday, because people tried to sell their stocks, but there were not enough buyers, which caused the size of the market to shrink, and a record 16 million shares were exchanged for smaller and smaller values as the day progressed. So in a matter of 10 short weeks, you can see the magnitude of the crisis, the tragedy. The value of the entire market was cut in half. So in parallel, there was a series of bank failures. One is mainly seen in the agriculture sector. There was default in farm mortgages, because at that time in 1920s 25, a kind of lots of mechanization in the US agriculture sector as well as globally had been taking place. And as a result, many farmers, because of the mechanization, they bought lots of new machines, and including tractor and other machines to increase for agricultural activities. For that, they borrowed lots of funds from the banks, and however, there was a little bit due to the adverse weather conditions, there was agriculture failure during this period in 1928-29, and as a result, there was defaults in mortgage loan by many farmers, and it led to loan losses on bank balance sheet in agriculture regions. And it prompted substantial withdrawal from banks, building to a full-fledged panic in November and December of 1930, with the stock market falling sharply. You know that when the banks, you see that when the banks face liquidity crisis because of the default on farm mortgages, the agriculture banks in the US is faced lots of liquidity crisis, and as a result, when people notice this, when the depositors notice that banks financial health is not so sound, not so great, and people began to withdraw their deposit, it further added fuel to the problem. Then the effects of the stock market crash, this was in parallel to this, it rippled throughout the economy. As a result, you know that actually when the stock market crash happened, the net worth of many firms declined, and they actually in order to revive they need more capital, and there is also more loan default by these firms, because their overall cash flow has declined, and as a result there was default in the loans by many firms. So as a result, nearly 700 banks failed in the waning months of 1929, and over 3,000 collapsed in 1930. So you can see by 1933, more than 1/3 of US commercial banks had failed. So that you can see that the bank failure is one of the key feature of any financial crisis, any economic crisis. So a manifestation of the rise in financial friction is that lenders began charging businesses much higher interest rates to protect themselves from credit losses. And banks realized that money they lent to future traders as margin would go unpaid. So as a result of closing banks, the general public also began to lose confidence in banks. So they gradually started withdrawing money from banks and holding it in currency. So in other words, there was continuous deposit withdrawal from the banks, and people not only withdrawal, they are not depositing their money in the banks at all. Instead, they prefer to keep whatever surplus that they are having, whatever savings that they are having, they prefer to keep it in cash forms. So the banks that survived the crisis were unwilling to lend money. You know why? Because they know that there will be high default risk because of the ongoing crisis, and it further worsened the situation. So about the Great Depression, there are lots of debates on what caused the Great Depression. So what macroeconomic theories can explain the Great Depression? In short, there is no consensus among economists and historians regarding the exact causes of the Great Depression. So the economic wisdom until 1930s that was more prevalent in economic thinking was classical economics. So their belief is that we don't need any kind of government intervention. They just believed in laissez-faire policy. That means the role of the government is just to manage the economy, that is the maintaining the law and order, not to economically, not manage the economy, not manage the economy. Other than that, main duty is mainly in maintaining the law and order. So for them, they didn't have a well developed theory that could explain the persistent and excessive unemployment or any policy recommendation to solve the problem. What their argument was that in the short run there will be some mismatch between aggregate demand and aggregate supply. There will be some disequilibrium, but in the long run there won't be any economic crisis. But that was the wisdom until 1929, but you can see that this economic crisis long lasted for nearly 1 decade. Then the new economic wisdom emerged under the leadership of John Maynard Keynes, and his argument was that he questioned the non-interventionist policy of the classical economists, that is the laissez-faire economic doctrine, and also he questioned the short-run argument of the classical economists, because classical economists say that in the short run this is natural to have some deviation in aggregate demand from aggregate supply, but it will be automatically corrected by the market mechanism. But Keynes, by seeing that it long lasted for nearly 10 years, his argument was that in the long run we are all dead. So why we worry? So the thing is that it's not only the long run, we also need to worry about the short run as well. So he argued for strong government intervention to revive the economy from the crisis. Then another group of economists, especially in the 1960s, they gave some explanation why the 1929 crisis emerged and how it could have, it could have prevented. So his argument was that money supply should have increased during the Great Depression period, so that the recession from turning to depression could have averted. So these are all the, especially by the monetarist economics, by using the data, they argued that look at this data, and their argument was that the economic policy during 1929 to 1940s, it was not sufficient enough to address the economic downturn, because the money stock fell rapidly due to bank failure. So increased current deposit ratio and failure of the central bank to take adequate expansionary measure. But they have shown that the money supply declined in the economy. Then there was about the fiscal policy that was weak, especially in 1929-30s, especially in the initial years. So attempts to balance what the policymakers did at that time was they made an attempt to balance the budget through increased taxes. And when the increased taxes means actually they are taking the purchasing power of the people away from them. So as a result, the aggregate demand, there is a decline in aggregate demand. So these are all contractionary policies at an inopportune time. So overall, the Keynesian explanation is that the essence of their explanation of the depression is contained in the simple aggregate demand. So they argued that the deficiency in aggregate demand is the root cause of 1929 depression, and what is required is government intervention, especially fiscal policy intervention, to revive the economy, to save the economy from turning the recession into a Great Depression. So in the 1920s, there was mass production, the economy was doing well, but in collapse in the 1930s resulted from drying up of investment opportunities, reduction in consumption expenditure and poor fiscal policy. So, the continuing on the Keynesian explanation, they argued that the classical economists, you know, that they believe in market mechanism, they believe in the private sector, they are against government intervention in the economy. But Keynes argued that private economy was inherently unstable, especially the private demand. Private sector investment demand is inherently unstable. So, we need active stabilization policy to maintain a strong economy. The stabilization policy is mainly in terms of when there is a deficiency in aggregate demand, it should be injected, they compensated by increase in government expenditure. That is another key component of aggregate demand. So, their suggestion is mainly to prevent, not only they suggested policy measure that could have prevented the Great Depression, their policy measures are also relevant to prevent future depressions. So, the policy response based on the Keynesian policy response, Keynesian revolution, the US government came up with several policy response. One, they accepted the Keynesian policy proposition that an expansionary fiscal policy is required. That means government expenditure should be increased. So, then they came up with the New Deal. This is a series of programs, public work projects and financial reforms and regulations enacted by President Franklin in the US to respond to the needs for relief, reform and recovery from the Great Depression. So, you can see that aggregate spending policy, it increased from 3.2% of the GDP in 1932 to 9.3% of the GDP in 1936. That is the government expenditure. So, in order to revive aggregate demand, government expenditure has increased. Then there was TVA authority formation, built dams and hydroelectric projects. That means they made more capital expenditure so that the people will get more income, purchasing power will increase, then the aggregate demand also will increase. Then in 1935 to 1943, there was second deal, that is a permanent jobs program that employed 8.5 million people in 1935 to 1943. The idea here is that the purchasing power of the people has to be increased through the government spending program. Then the World War II also led to cause little bit for the end of the depression because the production during the Second World War increased and the production increases to meet the demand led to the increased employment. And you know that Japanese attack on the Pearl Harbor in 1941 led to the America's entry into the World War II. As a result, nation factories went back into full production. So, between 1940 and 1942, US they entered the World War II and government purchases nearly quadrupled and adding significant economic demand. And this is little bit data on showing the different phases through which the economy passed through and then the government policy for the revival of the economy and to save the economy from the depression. And then the monetarist revolution later on, it was in 1960s, by studying the monetary transaction, the monetary money supply in the economy for almost for 1 decade. Friedman emphasized that the role of monetary policy in determining the behavior of output and prices. To him, money is the main factor that explain the variation in output and employment. So, he's argued that depression was evidence of the importance of monetary policy factors, and especially during 1930s, there was, when this crisis hit the economy, there was, instead of an expansionary monetary policy, what the Fed did was they followed a contractionary monetary policy that goes against the basic economic wisdom. So, there is lots of research paper on that. I am just showing you some research paper that showing that how Friedman and the Swalls claim that the fall in money supply during this period was one of the main reason how it could have been just a ordinary recession, but because of the contractionary monetary policy made it to a Great Depression. And there are some more research papers on this. they are showing that how a contractionary monetary policy played the role. So in this session, what we have done that we have discussed key aspects of the Great Depression of 1930s. Then we reviewed the series of events and causes that led to the Great Depression, and also we discussed some of the policy responses, and then finally how the Great Depression ended. Thank you for watching this session, and see you in the next session. Thank you.